Welcome. Today, we're diving into the world of solvency ratios, a crucial set of financial metrics that help us understand a company's ability to meet its long term obligations. Whether you're an investor, a business owner, or just curious about financial health, solvency ratios provide valuable insights into how stable and sustainable a business truly is. In this video, we'll break down what solvency ratios are, why they matter, and how they differ from other financial ratios. Let's start our journey by exploring the basics and setting the stage for a deeper understanding. Solvency ratios are financial tools used to measure a company's ability to meet its long-term debts and financial commitments. Unlike liquidity ratios, which focus on short-term obligations, solvency ratios take a broader view, looking at the overall capital structure and long-term financial health. These ratios are essential for stakeholders who want to assess whether a company can survive and thrive over the years, even during challenging times. By analyzing solvency ratios, we gain a clearer picture of a company's risk level and its capacity to weather financial storms. Understanding solvency is vital for anyone involved in business or investing. A company with strong solvency ratios is more likely to secure loans, attract investors, and maintain operations during economic downturns. On the other hand, weak solvency ratios can signal trouble ahead, making it harder for a business to grow or even survive. Lenders and investors often look at these ratios before making decisions, so knowing how to interpret them can give you a significant advantage. Let's see how these ratios fit into the bigger financial picture. It's easy to confuse solvency with liquidity, but they're not the same. Liquidity ratios, like the current ratio, focus on a company's ability to pay short-term debts using current assets. Solvency ratios, however, look at the long-term picture. Can the business meet its obligations years down the line? This distinction is important because a company might be liquid but not solvent, or vice versa. Understanding both concepts helps paint a complete picture of financial health. There are several solvency ratios commonly used in financial analysis. The most popular include the debt-to-equity ratio, the equity ratio, and the interest coverage ratio. Each of these ratios provides a different perspective on a company's financial structure and risk. By examining these ratios together, analysts can form a well-rounded view of a company's ability to meet its long-term obligations. In the next scenes, we'll break down each of these ratios and explain how they're calculated and interpreted. Debt-to-equity ratio is one of the most widely used solvency ratios. It compares a company's total liabilities to its shareholder equity, showing how much of the business is financed by debt versus owner investment. A high ratio can indicate higher risk, as the company relies more on borrowed money. Conversely, a lower ratio suggests a more conservative approach with less financial leverage. This ratio is crucial for understanding the balance between debt and equity in a company's capital structure. Calculate the debt-to-equity ratio. Simply divide total liabilities by total shareholder equity. For example, if a company has $500,000 in liabilities and $250,000 in equity, the ratio would be 2. This means the company uses $2 of debt for every dollar of equity. Understanding this calculation helps you quickly assess how leveraged a company is and whether it might face challenges in meeting its long-term obligations. Interpreting the debt-to-equity ratio requires context. A higher ratio isn't always bad. It depends on the industry and the company's growth strategy. Some industries, like utilities, operate safely with higher ratios, while others, like technology, may prefer lower leverage. It's important to compare a company's ratio to industry averages and consider its business model before making judgments. This approach ensures a fair and accurate assessment of financial risk. Equity ratio is another important solvency metric. It measures the proportion of total assets financed by shareholders' equity. A higher equity ratio indicates that a company is less reliant on debt, which generally means lower financial risk. This ratio is especially useful for investors who want to see how much of the company is owned outright versus financed through borrowing. Let's look at how this ratio is calculated and what it tells us about a company's financial health. Find the equity ratio, divide total equity by total assets. For example, if a company has $300,000 in equity and $600,000 in total assets, the equity ratio is 0.5 or 50%. This means half of the company's assets are financed by shareholders, not debt. A higher equity ratio is generally seen as a sign of financial strength, but as always, it's important to compare with industry norms. High equity ratio suggests a company is less dependent on external financing, which can be reassuring for investors and lenders. However, a very high ratio might also mean the company is not taking advantage of growth opportunities that come with responsible borrowing. As with other ratios, context is key. Always compare with similar companies and consider the company's strategy before drawing conclusions. Interest coverage ratio measures a company's ability to pay interest on its outstanding debt. It's calculated by dividing earnings before interest and taxes, EBIT, by interest expenses. A higher ratio means the company comfortably covers its interest payments, while a lower ratio could signal trouble. This ratio is especially important for lenders and investors who want to ensure the company isn't overburdened by debt costs. Calculate the interest coverage ratio, divide EBIT by interest expense. For example, if EBIT is $100,000 and interest expense is $20,000, the ratio is 5. This means the company earns 5 times what it needs to cover interest payments. A ratio above 2 is generally considered safe, but this can vary by industry and economic conditions. Strong interest coverage ratio indicates that a company is generating enough earnings to comfortably pay its interest expenses. However, a declining ratio can be a warning sign that the company's debt load is becoming unmanageable. Always look at trends over time and compare with industry peers to get a full picture of financial health. While the debt-to-equity, equity, and interest coverage ratios are the most common, there are other solvency ratios worth considering. These include the debt ratio, which compares total debt to total assets, and the fixed charge coverage ratio, which looks at a company's ability to cover all fixed financing expenses. Each ratio offers a unique perspective, so using several together provides a more comprehensive analysis. Debt ratio is a simple yet powerful solvency measure. It's calculated by dividing total debt by total assets. This ratio shows what portion of a company's assets are financed by debt. A lower debt ratio indicates less reliance on borrowing, while a higher ratio suggests greater financial risk. As always, it's important to compare this ratio to industry averages for meaningful insights. Fixed charge coverage ratio goes beyond interest payments, considering all fixed financing expenses such as lease payments. It's calculated by dividing earnings before interest, taxes, and fixed charges by the total fixed charges. This ratio gives a more complete picture of a company's ability to meet all its fixed financial commitments, not just interest. Real-world financial analysis, solvency ratios are used by investors, lenders, and company management to make informed decisions. For example, a bank might review a company's solvency ratios before approving a loan, while investors might use them to assess risk before buying shares. These ratios are also valuable for internal management, helping guide strategic decisions and long-term planning. Solvency ratios can vary widely between industries. For example, capital-intensive industries like utilities or manufacturing often have higher debt levels, while technology or service companies may operate with less debt. It's crucial to compare a company's ratios with industry benchmarks to get an accurate sense of financial health. This context helps avoid misinterpretation and leads to better decision-making. Looking at solvency ratios over several years can reveal important trends. A company with improving ratios is likely strengthening its financial position, while deteriorating ratios could signal trouble ahead. Trend analysis helps investors and managers spot potential issues early and take corrective action before problems become severe. While solvency ratios are powerful tools, they have limitations. They rely on accounting data, which can be influenced by management decisions or accounting policies. Ratios also don't capture qualitative factors like management quality or market conditions. That's why it's important to use solvency ratios alongside other financial and non-financial information for a complete analysis. Credit rating agencies often use solvency ratios as part of their assessment process. Strong ratios can lead to higher credit ratings, which lower borrowing costs and increase investor confidence. Conversely, weak ratios may result in downgrades, making it more expensive for companies to raise funds. Understanding this connection is vital for managing corporate finances effectively. Companies' solvency ratios can influence its growth opportunities. Strong solvency makes it easier to secure financing for expansion, while weak ratios might limit access to capital. Companies must balance the desire for growth with the need to maintain financial stability, using solvency ratios as a guide for responsible decision-making. Solvency ratios are a key part of risk management. By monitoring these ratios, companies can identify potential financial problems early and take steps to reduce risk. This might include restructuring debt, raising equity, or adjusting business strategies. Proactive risk management helps ensure long-term success and stability. Solvency ratios are calculated using data from a company's balance sheet and income statement. Key figures include total assets, total liabilities, shareholder equity, and interest expenses. Understanding where to find this information is the first step in performing your own solvency analysis. While solvency ratios focus on balance sheet data, cash flow is also important. A company might appear solvent on paper but struggle with cash flow issues that threaten its ability to pay debts. That's why analysts often look at cash flow statements alongside solvency ratios for a more complete picture. Solvency ratios are often used to assess bankruptcy risk. Companies with weak ratios are more likely to face financial distress and potential bankruptcy. By monitoring these ratios, stakeholders can spot warning signs early and take action to avoid serious problems. Investors use solvency ratios to evaluate potential investments. Strong ratios can indicate a safe, stable investment, while weak ratios may signal higher risk. By comparing ratios across companies and industries, investors can make more informed decisions and build stronger portfolios. Lenders also rely on solvency ratios when deciding whether to extend credit. Companies with strong ratios are more likely to receive favorable loan terms, while those with weak ratios may face higher interest rates or be denied credit altogether. Understanding how lenders use these ratios can help companies improve their financial standing. Corporate strategy is closely linked to solvency. Companies with strong solvency ratios have more flexibility to pursue new opportunities, invest in growth, or weather economic downturns. On the other hand, weak solvency can limit strategic options and increase vulnerability to market changes. Solvency ratios play a role in mergers and acquisitions. Acquiring companies often analyze the solvency of target firms to assess risk and determine fair value. Strong solvency ratios can make a company more attractive as an acquisition target, while weak ratios may raise red flags. Regulatory agencies often set minimum solvency requirements for certain industries, such as banking and insurance. These rules are designed to protect consumers and ensure the stability of the financial system. Companies must monitor their solvency ratios to remain compliant and avoid penalties. Good corporate governance includes regular monitoring of solvency ratios. Boards of directors and management teams use these ratios to guide decision-making and ensure the company remains financially healthy. Transparent reporting of solvency ratios also builds trust with investors and other stakeholders. Financial planning relies heavily on solvency ratios. By forecasting future ratios, companies can anticipate potential challenges and plan accordingly. This proactive approach helps ensure long-term stability and supports sustainable growth. Strong solvency ratios can enhance shareholder value by reducing financial risk and supporting steady growth. Investors are more likely to invest in companies with solid financial foundations, leading to higher stock prices and greater returns over time. Market perception is influenced by a company's solvency. Strong ratios can boost investor confidence and attract positive media attention, while weak ratios may lead to negative sentiment and falling stock prices. Managing solvency is not just about numbers, it's also about reputation. Economic cycles can impact solvency ratios. During downturns, companies may see declining earnings and rising debt levels, which can weaken solvency. Conversely, strong economic conditions often lead to improved ratios. Monitoring solvency through different cycles helps companies prepare for changing environments. For companies operating internationally, solvency ratios are especially important. Different countries have varying financial regulations and market conditions, which can affect a company's risk profile. Analyzing solvency on a global scale helps multinational firms manage risk and seize opportunities. Solvency ratios aren't just for large corporations. Small businesses can benefit from regular solvency analysis to ensure they're not overextending themselves. By keeping an eye on these ratios, small business owners can make smarter decisions and avoid financial pitfalls. Startups face unique solvency challenges. Rapid growth often requires significant investment, which can lead to higher debt levels. Monitoring solvency ratios helps startups balance growth ambitions with financial stability, increasing their chances of long-term success. Nonprofit organizations also use solvency ratios to ensure they can meet their long-term commitments. While the focus may differ from for-profit businesses, maintaining financial health is just as important for achieving their missions and serving their communities. Individuals can apply the concept of solvency to their own finances. By tracking personal debt and assets, you can calculate your own solvency ratios and make informed decisions about borrowing, investing, and saving for the future. Improving solvency ratios often involves reducing debt, increasing equity, or boosting earnings. Companies can achieve this by cutting costs, raising capital, or improving operational efficiency. Regular monitoring and proactive management are key to maintaining strong solvency. One common mistake is relying solely on solvency ratios without considering other factors. It's also important to avoid comparing ratios across unrelated industries or ignoring changes in accounting policies. A balanced approach leads to more accurate and useful analysis. Wrap-up solvency ratios are essential tools for assessing a company's long-term financial health. By understanding and monitoring these ratios, you can make better decisions as an investor, business owner, or financial professional. Remember to consider industry context, trends over time, and use solvency ratios alongside other financial metrics for a complete analysis. Thanks for joining us on this journey into solvency ratio.